All right. What time is it? It's time to talk about. What time is it? It's time to talk about sex. Oh, wrong song. What time is it? It's time to talk about death, baby. It's talk about you and me. And talk about all the good things you can buy once I'm deceased. Let's talk about death. Woo! You didn't know we were going to celebrate? We're about to talk about somebody getting paid. We don't know if it's you or me, though, right? Anyway, let's dive into this because statistics are showing that about 54%-ish of Americans have life insurance. Sounds like a lot, but when you start talking to these people, the other flip side of those statistics are that the Gen Xers like me and the boomers, like 50% of those people who have life insurance say they don't have enough life insurance. Now, if we go back and talk about the other 46% that doesn't have life insurance, let's start with the millennials because you know they think they're going to live forever, right? Not actually the reason why they're not buying life insurance. So, a survey showed that millennials aren't buying life insurance because they think a $250,000 policy is going to cost them $1,000 a year. Hello, that's like the price of a whole life policy with cash values and all those words we haven't learned about yet. So that's actually wrong. A $250,000 policy for a millennial is going to be under $200. It's going to be like $169. So one of the biggest things keeping people out of life insurance is the fact that they think it costs so much. Do some policies cost a lot? Yes, but we're going to get started talking about temporary policies. Temporary. Yeah, term policies, temporary. Why do we call them temporary? Because they cover a term. It doesn't run for the rest of my life. If I was going to go ahead and buy a term life policy for myself, I'd be picking a 10, 20, 30-year policy, right? But once that term, that time frame expires, if I didn't die, my beneficiaries don't get anything. Temporary. Now, the question is, why would anybody buy a temporary policy? Well, depending on where you jumped in on this course, a little while back we were talking about your learning years, which would be, let's just talk about those millennials going into high school, leaving high school, in college, transitioning in the workplace, maybe a couple of years into the workplace. Those are learning years. You're learning your craft, you're learning your trade, you're building up. You are earning, but you're not at your peak earning potential. Next step, just for illustration, we're going to jump into the next generation, Gen X, right? My group. I'm in my 40s, mind your business, right? But anyway, my group is what you would call in the middle, dead center of their earning years. Why? Because, we got our 10,000 hours. I know you don't think I'm a rookie at this, right? But in that time that we invested learning our craft, now we're accelerating. We're making our dough. This is when we're putting our investments together. This is when we're putting our second level risk mitigation in. Now, in these earning years, this is where my family actually has the greatest amount of risk because what if I died? Well, I can tell you right now, I don't plan on dying anytime soon. I definitely don't plan on dying within my earning years, right? So if I'm not planning on dying through my earning years, that means I'm going to get into retirement, right? But what if I did die during my earning years? That's the reason for the term policy. See, me, I'm trying to build an empire here and knock off ExamFX and WebCE and all these other busters with I could say that. I said all these other busters with subpar content. I'm trying to knock them off. I'm at a full-blown tilt, going in all the time. During my earning years, I'm heavily invested. If something was to happen to me, although we're trying to take over the world, doesn't mean that we are. What happens to the house? What happens to the cars, the kids, and all that stuff? So if something was to happen to me during those years where I'm building up for retirement, that's what the temporary policy is for. That's what your term life policy is. So right now, I'm 47 years old. Let's just look at it from a retirement standpoint. I take out a 20-year term on myself, right? By that time, I should be the largest education provider in the United States. Regardless, in that 20-year term, while I'm building, if something happens to me during that time period, that $250,000 policy we're talking about, boom, payable, right? But if I turn 67 and that term ends, nothing, nada. Most of the time, no cash values, no nothing. The policy that you're putting in place with a term policy is only there to cover me, my family, my loved ones, my business, the things that I care about. It's only there to cover me while I'm working on making it sufficient so it could cover itself. Does that make sense? Because the next step to that is not just covering somebody through a short period of time, it's covering them through a lifetime. Those policies are a little bit different. We're going to talk about that next. Those are the whole life policies, all right? Now, these term policies, to me, this is exactly where we need to start out. Why? Because this is step one, guys. We're going to get into how you modify these policies, types of policies. I already told you about uses for these policies. Another use for this policy would be what we call key person insurance. Key person would be somebody like, let's just say David over here. David is extremely valuable to me when it comes to the production of these classes, right? He's taking in all my video, all my audio. He's doing all of everything. If something was to happen to David, woo, I'm at a dead stop. I've got to rehire a whole new team to replace this dude, right? Key person. He is a key person to my business. That's an insurable interest. Oh, keyword, insurable interest. What do we mean by insurable interest? Well, you can't just go ahead and take out a policy on anyone, all right? So I already identified that I have an interest, a vested interest in David for his expertise, right? We have Kelly, which I've been mentioning throughout the class, and once you guys get licensed, that's who's going to help you with your continuing education and things like that. Well, she has a vested interest in me because we have a family, we have expenses. So a spouse can take out a policy on another spouse, a child on a parent, so as long as there's a relationship, you can't just go and take something out on your neighbor. It just doesn't work like that. Now, who else can you think of that has an insurable interest on you? Ding! Your lender, right? Your lenders have an insurable interest with you. What does that mean? All right, mortgages. Have you ever heard of mortgage insurance, guys? Mortgage insurance is actually a type of term policy, a temporary policy. Why? A mortgage has a time frame on it. So let's just say, we just moved in here. We have a 30-year mortgage for $250,000. Well, mortgage insurance, what it's saying is that we're going to take out for that 30-year mortgage, we're going to take out a 30-year term life insurance policy. So if you die during that 30-year term, we get paid, Kelly gets the house. Mortgage insurance. Makes sense, doesn't it? But see, that policy, that's what, remember I told you we were going to talk about three different types of policies? Well, I didn't say three, but now you know there's three different types of policies when it comes to term. You have a level benefit, which means that we talked about that $250,000 up front when we were talking about the millennials and how the millennials think it's going to cost them $1,000 a month. No. All right. So that level benefit, that means that you pick the policy that no matter how much time goes by, no matter what happens at the beginning of the policy, let's just say it's worth $250,000. At the end of the policy, it's still worth $250,000. Okay. Makes sense? I hope so. It's really, that's like the most basic possible scenario we could go through. The next one would be that mortgage scenario that we were talking about, right? Because if I took out the 30-year mortgage, if I died 15 years into paying my mortgage down, did I still owe let's just say $250,000? No, I didn't. So if my lender, who had an insurable interest on me, required me to go ahead and take out that mortgage insurance, would my lender, if I paid 15 years into the house, would it make sense for us to pay them $250,000? No, absolutely not. It makes sense for me to pay them what I owe them. And that's why the second one I want you to remember, the second type of term policy, is that depreciating term. Because if you have some kind of lending note and that person who lent you the money has an insurable interest, as you pay them back, the amount that you owe them goes down. So the amount that you are indemnifying them for, because if you were to die, they have no recourse, they can't get their money. So you're indemnifying. If you pass away and no longer have the ability to go ahead and pay them, you are making them whole. You are making sure that with this term life insurance policy, you are going to pay them 100% of what you owe them, because as the rate, as your balance decreases, so does the benefit. Okay, so in a level policy would be something that I would give to Kel, right? Because we're going to establish that our $250,000 is our benefit. It stays that way. Well, we wouldn't do that for our lender on the house. So for them, we give them a depreciating term policy, right? Now there's one more policy type when it comes to benefits that I want you to be aware of, and that's increasing term. Why on earth would it increase? I get it. Like, you kind of sit there and think about it for a second. Like, all right, well, because I want a bigger benefit. Well, yes, but the real reason in there, probably the number one reason, is that you got to think about inflation, guys. $1 today isn't worth the same as $1 tomorrow. So an increasing term would probably have something on it like a cost of living rider, which would make adjustments along with a cost of living index. These are, we'll talk about those, but you do see the key words, right, guys? Cost of living index, you know. So that's what we would use an increasing term for, because let's just say I did have that 30-year policy, right? Or did have a 30-year policy. And with that 30-year policy, you know, $250,000. Well, you know, if I die 25 years in from now, is the $250,000 going to go that far? The way things are going right now, no. I'd be lucky if I can go ahead and live on English muffins and cat food with $250,000. Good going, Gov. You know, but you ain't hear that from me. Actually, you know what? You heard it from me. You know why? Because I just want to flash back real quick. The federal government does not regulate insurance, so I actually like my state government. DeSantis! Oh, what's up, Patronus? Who's Patronus? Speaking of Mr. Patronus, bam! You know I love this site, right? Why do I love this site? I just gave you a quick overview of just a little flash of what term life insurance is, right? If we go over here to myfloridacfo.com, I'm over here looking around. I got cheat notes. I'm not even using my cheat notes. See, earning years. I know this stuff. I've done this before. No rookies. Anyway, so we're on myfloridacfo.com. If you had a question about term life insurance, would you come here? You do remember that the Florida CFO has a Department of Financial Services. This is the website. And they have a division dedicated exclusively to consumer services. Right? So let's go check it out. Divisions and offices. Third one down, consumer services. Bam! Welcome to the Division of Consumer Services. Doesn't it just sound like customer service, like they were here to help you with something? Well, we're talking about life insurance, right? So right here, understanding insurance. We're on the left-hand side of the column. Boom, click on that. Understanding insurance. Choose the right insurance for you. Right up top, consumer guides. Click on that. Ooh, we don't want property and casualty. We're in life and health. First one up there, annuities. We're going to get there, so you know what I'm going to do. When the annuity section comes up, what am I going to do? Oh, you know how much I like this website, right? But that's not what we're here. Let's go ahead and available for download. Bam. I had to turn it around, make sure it's still up there. You know, I go through post-traumatic stress sometimes because I'm over here talking, thinking David's keeping up on it. Nah, he's over there watching My Little Pony and whatnot. I'm over here thinking I got my Florida CFO, and he's look at this guy. If I knew how to use my tech, I was gonna screenshot you. I don't even know if I could do that. Look at that. My bad. My bad. Let me just stick with this though. Life and health. Let's download this life insurance PDF. All right. Now, this is exactly what I want you guys to do. You do realize that I didn't just grab my iPad and post this up and share it with you so you can watch me, right? I want you to go to myfloridacfo.com. I want you to go to myfloridacfo.com. Go to Consumer Services. When you get there on the left side, I want you to press Understanding Insurance. Why? Because you're in a class of Understanding Insurance, people. And if you realize what's happening right here, did I go to the textbook to explain insurance to you? No. We're setting expectations here. You know why? Because right now you're a customer. Right now, if I was the person who was communicating with you and we had an appointment, let's just say tomorrow, the first thing I would do is I would send you this life insurance guide. Right here. Bam. Why? Because how nice would it be for me to send you a state-authorized pamphlet that's all about the things that customers should know when discussing life insurance. This is setting the parameters. These are the expectations, okay? So if we come in here, table of contents, I'm not going to go all the way through this, but, you know, introduction to life insurance, traditional life insurance, you know, blah, blah, blah. But that's not really what I want. I want to talk about my term and whole life, right? So right here, we're not talking about term, not talking about whole life. We're talking about just term. So in this, we're what? What page is this? This is page 5, right? 2 choices of life insurance, term and whole life. I already told you that it covers a specific time period, right? Key characteristics, though. Premium is more affordable during the early years, during your early years. Why do you think I used the millennial example, guys? It's not term life insurance. What people expect to pay is in the ballpark of, you know, $1,000 a month for these bigger kind of policies. But no, term life insurance, because it's term, because it's not very likely we're going to die before our time. Life expectancy, although it did go down this year, went from like 77 to 76, okay? So no one is really, right now, if I took out a 30-year term, life expectancy is saying I'm still a good risk because I'm going to be 77 when my term policy ends, right? Now, let me get back to this thing. I'm going to make David edit that out because I was like, I was sitting there and I was thinking about my mortality, right? Because if you remember, us mere mortals die. I need you to remember that because I'm over here thinking about me being 77. I was like, right? I was just kidding. But the reason it's your premium is cheaper during the beginning is because, like, if we were to go ahead and take David, I got David beat by like 17 years, right? Obviously, this dude isn't going anywhere. Much, much more expensive to go ahead and implement a life insurance policy early on. That's not discrimination, okay? Discrimination would be excluding David completely because he's a millennial and they don't know any better, right? But that's not what we're going to do. Life insurance, because of that, the likelihood of death, if you're young, your premiums are low. If you're older, your premiums are higher. Why? Because you're getting to that time, guys. Oh, what did you think about my Mad T-shirt game? Coming out here talking about life insurance. I didn't even think about the fact that I'm rocking. I had to look I do these things for you guys, all right? Because I want you to sit there and while you're studying, be like, oh yeah, Simpsons, death. Let's talk about death, baby. Anyway, another key characteristic is it pays a benefit only if the insured dies during that covered period. Remember what I said? 20 years. If I do not die and I get to 20 years in one day and I don't renew that policy and I don't renew the policy, what happens? I get nothing. That means I paid them a premium for 20 years and get nothing. But I did cover myself during those earning years. So if something would have happened, I would have been able to go ahead and reintroduce that money, right? Pros and cons, man. Pros and cons. I'd rather live than die. Anyway, another thing about these term policies, they don't usually accumulate a cash value. Hello, keyword alert. They keep on, I should start ducking, right? It's like keywords there. Bah, bah, bah. But anyway, the reason that we're talking about this cash value, and it does say it usually does not accumulate, because policies can be modified, guys. So just right now, we're talking about the definition of term life insurance. I'm not talking about how we modify a life insurance policy. Believe me, if you got the money, and right now you're the client, if you're afraid of it, I'll cover it. Seriously, you want to talk about, what if I wanted cash values? What if I wanted long-term care? I'm gonna, in the following chapters, we're going to talk about how to turn life insurance into everything. I got articles over here talking about how we use life insurance to replace long-term care, how we use annuities to replace long-term care. A lot of these classes and a lot of these insurance types, there's a lot of options to it. So right now, think about this. You sitting there, we're totally on a customer-agent relationship, right? So anyway, let's get back to this. Last one. Is suitable for large amounts of coverage. So term life, you can get a lot of money out of a term life policy. I can have $1 million term life policy, right? The thing with life insurance, which is different from disability income insurance and some of those other health policies, with health insurance is assuming survival, right? Morbidity. Remember I used the other one? I'm a mere mortal, right? Mere mortal means mortals die. Morbidity, man, why are you being so morbid? You ain't gonna die, you're gonna survive, right? Health insurance deals with morbidity. Life insurance deals with your mortality, okay? So, with that, the reason that you can pay for $1 million, like honestly, guys, you can pick up you can make $50,000 a year, ride a bicycle to work, and spend all your money on $1 million life insurance policy. There's no restrictions on that, because you have to die in order to collect the benefit, unless you modified the contract, which we'll get into, right? But if we just make the quick if we continue making this comparison with with health insurance, that if you were injured at work, okay, because most people are covered under a work policy. If you were injured at work, or you were killed on the job or something like that, the insurance policy is replacing based on your income. Let's stick with injuries, all right? With health insurance, if I make 50 grand a year, I can't even get 50 grand in coverage, guys. Because if you paid me to go ahead $50,000 a year to keep my injured butt, and by the way, I'm over here gimped up. I don't even know why I'm standing. I got knee braces on. If you notice, I got a little bit of a hobble. I'm not trying to be thugged out, guys. I'm like 47 years old playing racquetball with millennials and getting hurt and whatnot, but whatever. But that's what brought me to disability income. If I can't work, I'm only going to get like 80% of my money, if that, right? So it's based totally on how much you're worth. Life insurance is based totally on how much you can afford. And that's where we're going to start transitioning. We're going to go into needs analysis, because this section is actually really, I don't want to say it's easy, but it kind of is. Like, it's going to get, when we transition into a whole life policy that stays with you for the entire life, not just a small term, you're going to start seeing, we're going to talk about the investment elements, but overall life insurance is super, super simple concept. If you can afford it, you can have it. So now with term coverage, we talked about your policy reaching the limit. Like you see right here. You can renew your policy. So let's just say we're getting down to the wire. And let's say you have a 10-year, I got a 10-year policy on me, right? There's renewability clauses where if I want to keep my insurance policy, I don't have to go into underwriting. I don't have to prove I'm healthy as long as I do it within that time frame, which means there's no evidence of insurability. Evidence of insurability. I don't have to do it as long as I keep my policy in good standing. When it starts coming up, if I want to go ahead and extend that policy, I can go ahead and extend that policy without proving that I'm healthy. All right. Now, the difference is if I come in 10 years from now, I'll be 57 years old. What's going to happen to my policy? Rates are going to go up. Why? Because at 57, the likelihood of me dying went up from me being 47. So that's where your premium factors are going to come in. Now, a term policy can also be convertible. That doesn't mean you can trade your term policy in for a midlife crisis drop top, right? It means you can turn your temporary policy into a whole life policy. But you don't even know what that is. You just know that temporary covers a term and whole life covers you forever, right? Well, maybe when you got started in your earning years, you couldn't afford a whole life policy. Those whole life, that's where you get the cash values. That means that it's more like a savings account, okay? So you're dishing your money into this account, it's earning money, but what if you don't die? That's going to be the question, right? Well, anyway, so your term insurance policy can be convertible. It means you can exchange a policy for a whole life policy without providing evidence of insurability, meaning I can transition this from a short term to a forever product without having to prove that I'm healthy. Why? Because I already have the policy in place. And that's really one of the biggest, we're going to get into this in some of the later chapters, but as an insurance agent, it's not professionally responsible for me to come to you and automatically try to replace a policy. Especially when we get into some of the other products, like when we get down to the annuities, it could almost be criminal for you to replace an annuity on a client. And we'll get into that because it's suitability, it's client needs, right? So if I was going to go see a client that maybe has a policy in place and they've had it in place for 10 years, 15 years or something like that, if I go ahead and try to replace that policy, underwriting might be unfavorable for them and it might not be in the best interest of that person. So we have to make sure that you being my client, when I come to see you, the reason that I'm giving you, resources like the life insurance consumer guide is because I want you to be able to understand what suits your needs, what could, and then you should be able to rely on me to talk you off of certain ledges. Like, what do I mean by that? If we're sitting down and you have a fear that might be a little irrational or something in reference to benefit levels that I feel would hinder your quality of life, is that a good way of saying it? Like if I took your budget down to a point where you couldn't afford to live because of your death benefits, it would be irresponsible of me as a professional agent. However, it would also be irresponsible of me to take away your ability to go ahead and spend all your money on a life insurance policy, because maybe it's not about you. Maybe it's about people you're leaving behind in a legacy. So what I want to do here is I want you to skim through this, and when we get back in the next segment, we're going to jump into whole life specifics, all right? So here, real quick, I'm going to fade out, and I want you to take a look at all the key words that are in that eye flash. Let's talk about death, baby.
Wow.